Hello and welcome to LAT's Weekly Market Insights. The Federal Reserve concluded Wednesday its January monetary policy meeting, indicating that a potential rate hike could come in March. The major stock market averages initially jumped when the Fed released its policy statement. However, stocks gave up those gains and turned lower as Jerome Powell answered questions in the press conference. Jerome Powell may consider the first half-point interest rate increase in more than 2 decades later this year if he needs a shock and awe approach to counter persistently high inflation that risks feeding into American psychology. The major averages hit fresh session lows as traders assess Jerome Powell's comments and monetary policy at the potential for even more inflation going forward. The Dow was down around 350 points or 1%, the S&P and the Nasdaq dipped 0.9 and 0.7% respectively. Meanwhile, rates rose as Powell spoke. The benchmark 10-year yield traded around 1.83% and the 2-year traded around 1.1%. Jerome Powell went on to say that there's a risk that inflation will not decline back to its pre-pandemic levels anytime soon, completely taking out that prospect of it being transitory, and that the rise in prices could even accelerate. Powell also mentioned that supply chain issues were taking longer to be resolved than the Fed had originally anticipated. Now, all of this, when it reflected in the charts, has been an incredibly hawkish outcome. We can see dollar strength across the board. Starting with the dollar index, we saw key levels breaking down prior to this release on the Wednesday earlier on in the month, before we saw acceleration of that buying intensifying ahead of the Fed's meeting. We saw these higher lows being posted. It came in after the retest of the round number. Higher lows consistently coming in before we broke through these highs, and then of course the ultimate catalyst coming from the announcement from Jerome Powell. That had the catalyst and the power to break through previous resistance highs, and of course now enabling the continuation of this longer term daily uptrend that we can see here in the dollar index. That, of course, reflecting down through to some of the major currency crosses. Euro dollar here continuing its major downtrend, having failed at the double top up at the previous highs of 115, the round number in the monthly pivots. It's been a straight downhill path from there. Clear technical lower highs and lower lows with respect for some of our secondary pivot points along the way. Now 111 and 110 look like clear targets. There has been a slight pause in a consolidation over the past 24 hours or so. It's a similar story in cable, again double top formations at the highs before trending lower, and again respecting our pivot points and round numbers along the way as we broke down through 135 and now sit below the monthly pivot point where we're trading at 133. The moves weren't just in the dollar currencies. Of course, we saw moves in the bond market. We can see here the 10-year ultra bonds here moving higher. Strong key support levels coming in here and a break up through. Again, pivots, round numbers being respected along the way. But it was really that press conference which prompted the acceleration of buying pressure here, which started back from these lows down at 1924. Next site here now, big round number. Up at 20, and we'll see if these highs can be tested and taken out. Of course, should we see these bonds moving higher, we're going to want to see, expectation would be to see our equities continue to sell off, and it's in the Nasdaq here that we can see that sustained selling pressure. Here, just looking at the 4-hour chart, again lower lows, lower highs in play, and now a slight pause and a consolidation over the past sort of 3 or 4 days, really following on from that announcement, as markets try and ascertain if this is the start of bear phase 1 and a continuation lower, or if we're going to see any buying and positivity come into it. For now, indecision in the market, and we'll wait to see if there are some key levels to be tested. If we just bring this out to the daily chart, we can see the double top formation helping support the more bearish outlook, and we can also see previous highs taken out here at 14,500, and now looking at lows down through here at 13, and then of course where we're trapped at the moment, these are the previous highs back through at 14,000. It's those highs which currently still hold this market up. A breakdown through these, expectation looking for a more impulsive move, perhaps down towards the 13,000 marker. The outperformer on the story throughout all of this, of course, continues to be oil. Its major dominance and bullish uptrend, people still and experts still touting for oil to move to 100. Again, a slight pause and a consolidation in and amongst such a fundamentally dominant week, but nonetheless, this trend still holding firm, breaking through previous highs, and now, like many of these markets, respecting this monthly pivot, just taking a pause and a breather in and around this region. Of course, a move up towards $90 a barrel potentially on the cards here, and this who's going to bet against the dominance of such this trend at the moment. But again, like many of these markets, paralyzed over the last few days, unable to move whilst this incredibly hawkish Fed and Jerome Powell is digested. So we'll be looking towards next week to see if this continued dollar theme remains, and if we can get some movement back within some of the risk commodities and of course the equity space. Now, following on from all the remarks from Jerome Powell on Wednesday, he went on to tell reporters that the economy is strong enough on its own now and without intense monetary policy support. In light of the remarkable progress we've seen in the labour market and inflation that is well above our 2% long-run goal, the economy no longer needs sustained high levels of monetary policy. The comments there coming from Jerome Powell during the press conference. Powell also pointed out the fact that job openings currently outnumber unemployment. Americans, just one reason why the labour market is very, very strong. Now, the headline unemployment rate has fallen below 4%, though labour force participation is still below its pre-pandemic level. The Federal Reserve did not specify its main statement when it might begin to reduce its bond holdings and have caused its balance sheet to swell to nearly $9 trillion. But in a separate statement released on Wednesday, the Fed said it would start shrinking the balance sheet after raising interest rates. Now, focus towards next week, we'll start to dial in on Super Thursday. We're going to have the Bank of England out of action, and more importantly than that will be Christine Lagarde and the ECB. Currently, probably one of the more dovish central banks, certainly relative to the Fed and Jerome Powell. We're looking to see if Christine Lagarde is going to take a more hawkish stance, start to look at tapering some of their support, in which case we may see a bit of a relief rally here in euro-dollar as we get a more hawkish tone and therefore a strengthening of the euro. All eyes towards that next Thursday for the BOE and the ECB. Until then, happy trading, have a really good weekend, and we'll speak to you all at the same time next week.